U.S. President Obama reaches a deal with House and Senate leaders to avoid a debt default. Politics and money converge in a critical last-minute agreement in Washington. Is this a real remedy or a temporary patch-up? This is Inside Story. Welcome to the program. I'm Hazem Seeker. Well, it's a move in the right direction, but it's not a deal yet set into law. After weeks of haggling and brinkmanship, senior U.S. lawmakers have finally agreed on how to avoid debt default with a deal in principle to raise the borrowing limit. But the agreement has to be voted in both houses of Congress, and President Barack Obama made the announcement on Sunday. He said it is not what he had hoped to achieve.
Is this the deal I would have preferred? No. I believe that we could have made the tough choices required on entitlement reform and tax reform right now, rather than through a special congressional committee process. But this compromise does make a serious down payment on the deficit reduction we need and gives each party a strong incentive to get a balanced plan done before the end of the year. Most importantly, it will allow us to avoid default and end the crisis that Washington imposed on the rest of America. It ensures also that we will not face this same kind of crisis again in 6 months or 8 months or 12 months.
Well, the deal was made just one day before the world's biggest economy starts running out of money to pay its bills. America's debt ceiling currently stands at $14.3 trillion. The deal agreed by Republicans and Democrats on Sunday will raise the borrowing limit by another $2.1 trillion. It also approves spending cuts that will start to take effect in 2013 of more than $2.4 trillion. But this deal still has to be passed by Congress before Tuesday to prevent the U.S. from defaulting on its debt. Well, joining us now to talk more about this are our three guests. From New York City, Michael Finger, communications specialist for Euro Pacific Capital, an American brokerage firm. From Dubai, Karen Young, a professor of political science at the American University in Sharjah. Ms. Young specializes in political economy and the politics of financial crisis. And joining us via broadband from the state of Louisiana to give us a more human face to this debt crisis, David Moore, an American worker. Well, thank you to all three of you for taking the time to speak to us. Michael Finger in New York, if I could start with you. What do you make of this debt agreement? Has it gone any way in calming the fears not only among Americans but among the rest of the world on America's economic course?
Well, it may have gone some way to calming the fears, but the fears were misplaced. The debt deal that was reached last night is really a failure out of the gate. It raises the borrowing limit right now, allows the government to continue its profligacy, but it doesn't actually make any substantial cuts, as the president said. So we're really, it's a failure. It's a patch-up, and it doesn't address the major structural problems that need to be addressed for the U.S. to get back on a sustainable course. It relies on triggers that, as Bloomberg reported, have a long history of failure, and a bipartisan budget committees, of which 3 have been called in the past year, yielding no results.
And who's responsible for this failure? Because I want to read you the New York Times, which admittedly is not a newspaper that a lot of conservatives consider their favorite paper, but they've said that this deal is a complete failure and it's a complete capitulation to the hostage-taking demands of Republican extremists. And they say that it will hurt programs for the poor and economic recovery. Pretty strong words, though, by any standards. Is that fair?
I think it's fair to call it a failure, but they're calling it for the wrong reasons. The Republicans didn't stand firmly enough for cuts. There really aren't any substantial cuts in the next few years. The cuts that are claimed are back-end loaded, so we're looking at them multiple years down the line. We're facing an ongoing financial crisis now. We need solutions now. We've got a $1.5 trillion annual deficit. It's escalating every year. So the markets, in order for the dollar to reverse its ongoing losses and for the markets to regain confidence in the U.S. and U.S. debt, they really need to make substantial changes, not only to end the deficit, but to go into surpluses. So we're going to be able to handle the unfunded liabilities that are coming up with Medicare and Social Security. So we're really looking at a complete sea change is what's required, and what we got here is really more of the same.
Karen Young in Dubai, what repercussions is this going to have for the economies and markets beyond the United States? Because it's probably pretty fair to say, in the eyes of much of the world, that the United States over the last few days hasn't exactly covered itself in glory here.
Well, I think, that's an interesting question, but the United States, like much of the G8, the major economies of the world, is facing the same kinds of challenges. We've got demographic challenges in paying for the social security expenses that are becoming more than we can meet with what the government is taking in terms of tax revenue. But one of the issues that I think is very important here is that there are a couple of fallacies which I see in this debate. And one is the idea that a debt ceiling is the same as a deficit reduction policy, and it's not. They're completely separate issues. A debt ceiling is the point of paying for programs that have already been approved by Congress. So this is part of what I see as the Republican Party's hypocrisy in agreeing to fund programs and then not agreeing to raise the debt to complete that payment and creating sort of a crisis moment, which was really unnecessary. The second issue.
Well, both parties are responsible.
Yes, you're right, and I think
for pushing for more spending. What the debt ceiling is saying, the debt ceiling says that there is a limit to what we can borrow. Any new spending that's approved by either party right now is from borrowed money. This is money from China. This is money from printing from the Federal Reserve, devaluing the bank accounts of every family in the United States. So this is a speed limit. It's a time to stop and say, we don't have the money to be approving that new spending, and we need to have a debate and find out where the cuts need to be made.
But this is not how traditionally the process works. I mean, since 1960, the debt ceiling has been raised almost 80 times. Most, in the majority of cases, by Republican administrations. So, raising the debt ceiling is really a normal kind of process that's been happening for 50 years. In this instance, it's become incredibly politicized because there's some other major debates which rightly should be happening in American politics. One is that we've got rising inequality. And that we've got this deficit issue that people don't understand why the government can spend more money, but their own lives aren't really getting better. And this is maybe the conversation that would have been more productive to take place, but instead it's been linking the debt ceiling to sort of other larger issues in the American recovery.
Yeah, Michael Finger, I mean, Karen Young makes the point there that debt ceilings have been raised dozens of times by the U.S. government with the agreement of both Democrats and Republicans. Why has it been so difficult this time around? Why all of the political wrangling?
Well, the reality is the debt ceiling is there for a purpose. And if it's going to be raised every time they approach it, then we should just abolish it altogether. But the reason that there's a debate right now is because if Congress doesn't impose on itself some kind of check on this out-of-control spending, then the market is going to do it. Right now, interest rates are low. We have lived on the back of a privileged reserve currency for many years, but the markets are not going to give us a free pass forever. So interest rates are headed up. And if Congress isn't able to deal with this, if they aren't able to impose limits on themselves, which is what the debt ceiling is, then the markets will do it for them, and that's a lot worse case scenario. So we're talking about, the word default has been thrown around. Really, we're talking about Congress not being able to prioritize spending. So if this debt ceiling was not raised, then the Treasury would be charged, the President would be charged with prioritizing spending. The point is that someone has to do it, whether it's Congress or the President, or the markets are going to do it for us. And that's going to be an uncontrolled default and really a worst case scenario.
All right, let's turn to our guest in Louisiana for his perspective on this. David Moore in Louisiana. I understand you are a lecturer at a college in that state. And as a skilled professional, you have struggled to find work like many Americans have. But as someone who's seen the political theater unfolding in Washington over the last few days, what is your perspective of what you've seen on the ground level? Does any of this give you any hope for the country's economic future?
Honestly, no, it doesn't. From my perspective, I'm looking around and my peers are telling me that they're being let go from their jobs 1 year before, or even only months before their retirement could kick in. The economy is in a serious state right now, especially for those of my working class, and especially the poverty stricken. And to hear things alarming things such as spending being cut, in social services programs, things that people need in order to survive in this country and have come to be dependent on due to circumstance, is it's very disturbing.
Yeah, let's put that point back to Michael Finger in New York. I mean, a lot of people, we are in difficult times here. A lot of people are being asked to pay their share of the burden. People on Social Security benefits, Medicare benefits, and so on, who are being told that those benefits are being cut. And that is fair enough in these difficult times. But if you're going to do that, you've got to make the same. You've got to ask people who are making $250,000 a year, for example, to pay higher taxes. Doesn't that seem fairer?
Well, I think the interesting point there is that this belies the claims of economists on the left that all these stimulus programs, monetary stimulus, fiscal stimulus, were going to bring about a genuine recovery. There's a lot of talk of a jobless recovery. If you look at the latest GDP numbers, I think they prove that what we have is an ongoing recession. And we're going deeper into a recession. I think David is experiencing that firsthand. And seeing that all the claims that if we would just spend more, if we could just increase taxes, if we could just increase regulation and set Wall Street correctly, that we would be back on the road to recovery. Well, that's clearly not the case.
Some people would argue that it was a lack of regulation that got us into this mess in the first place.
Well, we don't think that's the case. We think it was too much intervention by the federal government. If you look at the housing bubble, our CEO, Peter Schiff, has been on television since 2002, 2003, explaining how programs like Fannie Mae, Freddie Mac, FHA were going to blow up a housing bubble, and that when it crashed, we'd be in serious disarray. But the point is that since 2008, we really have gone with the Keynesian prescription. We've gone with the more spending prescription for fixing this problem, and it hasn't worked. So really, it's high time for people like David and people like the rest of us.
All right, Karen Young,
please.
You want to jump in here? You can't spend your way out of this continuously, can you?
Well, there's a bit of middle ground here. I mean, for starters, the opposite choice is that restricted fiscal policy is going to build business confidence. And there's no evidence for that either. The fact is that G8 economies are shrinking, that they have, and the only way that we are going to pay for the social programs, which we all like and enjoy, is to increase taxes. Now, part of the recovery of the 2008, let's think about where this debt came from. And maybe a portion of it, of course, about 10%, economists estimate, came from the 2008 rescue program, the TARP program in particular. Now, whether you agree with that program, whether it was a success or a failure, it's not the majority of where our debt is coming from. A lot of it began with the Bush tax cuts. Secondly, the wars after 2003 was the greatest jump. Let me finish. And the third is the Medicare and the prescription drug plan, also under the Bush administration. So much of this spending is not necessarily a Democrat Keynesian type approach, right? These were policies that were enacted well before the Obama administration. The other issue in terms of generating economic growth and recovery from the business side, will you please let me finish, is that there's $2 trillion sitting in corporate treasuries right now. So businesses in the United States are seeing higher profits. They're paying their executives more than ever. And they haven't done their part to stimulate economic growth in the U.S. economy. So for the banks that took money from the U.S. in the
businesses are
bailout, they
seeing
have a
higher
particular
profit.
moral
Businesses
responsibility.
are seeing higher profits.
All right, Michael Finger,
because
let me just jump in here
they
for a
have
second.
cut-
Let me just jump in here for a second. I'll give you a chance to respond in just a moment. But I just want to get back to David Moore's perspective on this and the point that Karen was making, that a lot of companies are making profits, but that's not being translated into jobs, into more jobs. Why do you think that is?
Honestly, from my perspective, I can't tell you because I'm not in the big business realm, but I can tell you that small businesses are suffering tremendously, and the majority of businesses are small. So the majority of our population here, I probably represent. And I'm saying that all of the companies that I'm familiar with that are like 100 employees or less range are suffering greatly. We can see the recorded high corporate profit, but we realize that has absolutely zero effect on small business owners, on their workers, and on those at the poverty level and below. And that's the majority of the United States of America.
And if the ratings agencies, as at least a couple of them have talked about doing, if they end up downgrading America's AAA credit rating, even if we do get a final deal here, what practical effect is that going to have on somebody like yourself, on people that you know where you are in Louisiana, on small businesses, as you say, who want to more money to finance their businesses, people who want to mortgage? Are they going to have to pay higher interest rates?
I don't know if that translates to higher interest rates in small loan terms, but I do know that my concern is 90% plus of the products that I buy in order to survive and handle daily life are imported from other countries. So I'm very concerned about the value of the dollar and what that's going to do to an external inflation situation. I'm not that impressed when I hear about how domestic inflation shouldn't be a concern. I'm concerned about what I'm going to pay for bananas from, an island country somewhere, because that's my daily reality.
Michael Finger, I know you want to jump in here.
That's very insightful, David. That's exactly our point. Is what small businesses need is lower taxes, lower regulations. Now, we're talking about taxes of people who make over $200,000 a year. Those are small business owners. You're capturing a lot of small business owners, and they have no reason to hire anymore. There are so many regulations, there's so much liability, that basically what the U.S. government is telling to small business owners is don't hire people. Do whatever you can to offshore, outsource, and avoid hiring American workers, because you're going to get hit with lawsuits, you're going to get hit with new taxes, and you're going to be blamed, you're going to be vilified. So yes, and inflation is a key to this, because small businesses, any business, large business, small business, needs a stable environment in which to grow. And with the dollar rapidly devaluing, we're creating a lot of regime uncertainty. We're creating it's making it very hard for small business owners to calculate how much are things going to cost in 6 months or a year's time. And that's only going to get worse. Until a major alignment is made and we can begin to pay back our debts and embark on a true strong dollar policy, then these problems are only going to increase. And the real default, because we have a reserve currency, is that they're going to continue to print money to pay back the nominal value of treasuries and interest. And that's really a worst case scenario. Then you're talking about really monetary chaos. And other countries have gone down this road. Argentina's gone down this road, Hungary, Weimar Germany, and it never works. So there really needs to be a sea change in Washington, and we don't blame Democrats in particular. We blame the Republican administration. Peter Schiff, our CEO, is a big critic of George W. Bush's economic policies. Certainly, it's by both parties, but the point is that it needs to change. And by raising the debt ceiling, we're really just telling them you can continue on down the road you're going. And we're not putting any natural checks onto their spending. So that's the key. Is we need to get both parties. We need to get everyone involved to really have a change of will and really want to deal with this problem fundamentally. And this bill does nothing to do that.
To Karen Young. I mean, if I'm going to a bank and I've got debts and I want more money to finance whatever it is I need to finance, I go to my bank manager and he gives me a massive overdraft. Isn't that basically what's being done here? that it's not really dealing with the long-term problem?
In some ways, but really, again, the debt ceiling is not the same as a deficit reduction program. They're two separate issues. And what the Congress needs to differentiate for the American people and for outside investors to understand it, well, it needs to happen. And this is a point on which I think we agree. But the debt ceiling is not the venue for that debate. So putting the U.S. into jeopardy and making international creditors think, oh, we're at risk of default, is not the right message to send. Now, you mentioned some issues about hyperinflation, about governments that have chosen restricted monetary policy, and I know a lot about those. And this is not any kind of option that the U.S. is looking at, so it's really quite separate. Will we see more inflation? Yes, probably. But that's more part of a global trend in terms of food prices than it is about U.S. dynamics. Interest rates are very, very low in the United States. And so, you know, the issue here is there are some bigger debates that need to happen in the U.S. and they're about income inequality.
The Fed is printing money. Just for that point, interest rates are low because the Fed is printing money and buying 75% of all new treasuries issued. So that is an artificial price.
Yes, they do, and the Chinese buy 26%, so it's a very nice relationship.
All right, clearly different points of view here, but I just want to ask both of you one question, because regardless of where you stand on some of these issues in principle, whether you believe higher taxes are needed to finance this debt or whether it should come from lower government spending, what we've seen in Washington over the last few days and what they've agreed on, is it basically just kicking the can down the road? They haven't really dealt with this. They've had a major opportunity here to deal with this decisively, and they haven't done that. They've basically just kicked the can down the road, haven't they? Karen Young.
That's exactly right. That's exactly right. And so the bigger issues are still to be discussed, and that's going to be a big issue. You know, Americans are not like Europeans in that we can accept paying high taxes for the social services that we enjoy. And what's also different now is that more and more Americans are accepting entitlement programs from the government. These numbers have quadrupled, especially since 2008. We're seeing 1 in 7 Americans receiving some kind of assistance from the government. And in a moment of a recession, it's not the moment to cut the cord and to stop these payments to people who really are in need. But it's a long-term issue which we're going to have to make a choice as a nation how much we believe that we all ought to pay in order to fund these kind of programs. One of the issues, though, is that wealth is so concentrated in the United States more than ever before.
This is certainly a stopgap measure, and if we do make the choice to go to a high tax model, then we have to accept a lower standard of living, which is where we're going right now with the dollar collapsing.
All right.
The luxuries that Americans have come to know and enjoy will be absent in a high tax, high regulation environment. And that's the reality. And I don't think most Americans are prepared to accept that.
Well, let's just take a step back now and look at how the United States compares with the rest of the world on this. Though the world's attention has been focused on the U.S. debt crisis, which currently stands at about 92.7% of the GDP, the gross domestic product, other countries across the world share similar, if not worse, debts. According to statistics, countries across Europe reflect lower debts as a percentage of GDP, with the UK at 76.7%. France is at 84.2%. A main exception across the continent is Greece at 130.2%, and the country has acquired bailout packages from the EU. Moving towards Asia, Japan's debt is a staggering 225.9% of its GDP, whilst China is only 19.1%. So just a flavor there of how the United States compares with other countries on this. So this is obviously a global problem, and different countries have been dealing with it in different ways. But I just want to turn in the couple of minutes or so that we have left here back to David Moore on this. Based on what you've read about how perhaps other countries have dealt with this, whether raising taxes is a solution or cutting government spending or a combination of both. Where do you think the solution should lie here? Should it be somewhere in the middle ground?
If there were some way for we, the American people, to get a chokehold on our Congress and force them to stop spending more than our revenue, then we would have an opportunity to pay back the debt. And I think that I, for one, would be willing to pay a higher tax if I had to make that happen. But my fear, and I think the concern of a lot of people in my position, is that we're going to pay a higher tax and as a result be in even more debt than before because Congress seems to be addicted to spending more than we can possibly give them.
All right, that is going to have to be the last word. We are unfortunately out of time, but I want to thank all three of our guests for taking part in what I'm sure you agree has been a very spirited discussion. Michael Finger, Karen Young, and David Moore. Many thanks for your time.
Thank you.
And thank you for joining us here on this edition of Inside Story. As always, we welcome your comments and suggestions. You can email them to us anytime at insidestory@aljazeera.net. Bye for now.